everyone, my name is Candice Peck, and I'd like to welcome you to Investing 101. Tonight, we'd like to spend some time demystifying the concept of investing and talking about why it's important to start sooner rather than later. My colleague Aiden will take you through some of the buzzwords you keep hearing, like stocks, bonds, the markets, returns. He's going to tell you what they mean and why they matter. Tonight is about you. You're the reason we're here. And so I encourage you to participate in the polls as and when they happen, and ask the questions in the Q&A box below whenever you think of something or if you don't understand. No matter how old you are or how little you know, ask the question. We're all here to learn. If we're not able to get through all of the questions in the time that we have tonight, we'll make sure to answer them in an email to you over the next couple of days. So before I hand you over to Aiden, one of Seidel's most esteemed wealth consultants, there's one last thing I'd like to mention. Once this webinar ends, you'll be redirected to a page where you'll see a short quiz of 10 questions. These questions are based on what we're going to talk about this evening. If you fill out the quiz, we have 4 Amazon gift cards valued at $50 each that we'd like to give away. And you could be one of the lucky winners. So without further ado, Aiden, let's get the show on the road.
Awesome. Thanks, Candice, so much for the warm introduction. And thanks to you all for tuning in tonight. As Candice mentioned, I want this to be fun and interactive and informal. So if you have any comments or questions throughout the presentation, please feel free to use the chat or reach out to me after the presentation. But let's get started. I'm going to share my screen and take you through the presentation. Okay, so let's get into it. And before I get into the content, I just want to remind everyone that this presentation is for educational purposes only, and it should not be relied upon for any investment decisions. In terms of content in today's presentation, we're first going to answer the question of why do we invest? We'll then talk about the things that you can invest in. I'll take you through the traditional asset classes and how they work. We'll talk about the difference between investing versus saving. And then I'll explain the importance of starting early. And then we'll do a background on Seidel. So let's get started. Let's jump in. And first off, I'm sure you're all wondering, what is this thing called investing all about, right? Why do people invest in the first place? And what is the purpose of investing? And when you think about investing, you might think, or you might hear that it's about hitting the jackpot, and it's about going to the moon, as some of the kids might say, or you might think that it's about getting the next big thing, or that it's for wealthy people only. But the reality is that investing is for everyone, no matter how much money you have. And it's not about gambling or speculating, rather, it's about achieving your financial goals, right? We all have goals, some that are short-term, some that are medium-term, others that are long-term. For the high school students who are on the call tonight, I'm sure your goal is to get through final exams, but in the future, you might want to buy a car or buy a house, retire at a certain age, start a business, etc. And in order to achieve these goals, investing your money in financial instruments is the key to turning your life goals into reality, right? Investing helps you get from where you are here today, which is down here, to your goals, which are up here, and it helps fill in this planning gap. Because if you didn't invest and you didn't plan for your future, you might end up on this lower trajectory line down here. I don't know if you can see it, but I'll just draw the line, where you end up falling short of your goals. So we now know that the reason why we invest is to achieve our financial goals. I wanted to pause and ask all of you about your financial goals. In the future, what will you be investing for? And if you're currently investing, what are some of the goals that you're investing for? You see, we all have goals that we hope to meet in the future, and we need to save and invest our money in order to get to where we want to go. So now we know, right, why we invest. Now let's get into what can you invest in. And as you can see by this busy and chaotic slide, there are many different things that you can invest in. Everything from what we call traditional assets, which are stocks and bonds, to things like physical assets, which are down on the left, like real estate, art, and gold, to what we call alternative assets, This is sort of things like hedge funds, private equity, not drawing too well today, but private equity and venture capital, and new and emerging assets like NFTs and crypto. Today, we'll focus primarily on the traditional asset classes, so stocks and bonds, as they're known to be the keystone of investing, as they offer the most direct method in which you can participate in corporate success. And they're the biggest bubbles for a reason, as they're the most popular. But if you have any questions about any of these other asset classes, I encourage you to reach out after the presentation, and I'd be happy to chat further. But let's dive in. Let's jump into what is a stock, what is a bond, how do these things work, and why should I be investing in it? So first off, another question for all of you: what is a stock? Is it A, a picture of a monkey with sunglasses? Is it B, just a gambling chip and something that you speculate with? Or is it C, ownership in a business? The answer is C, ownership in a business. A stock represents ownership in a company. So when you buy a stock, you're effectively becoming an owner in that company. And companies sell shares in their business to raise money for a variety of reasons. It could be to fund a new product or product lines, to expand their operations into a new market, to raise money to invest in growth, et cetera. And stock can be boiled down to a really simple example. So let's say there's a local ice cream business that would like to raise money to open up a second location. They decide to sell ownership in their company, and they split their company up into 10 pieces, which is down here. Let's say they value the company at $1,000. And again, this is all hypothetical, but they value it at $1,000, making each one of these pieces or each one of these shares, and shares and stocks, they're synonymous with each other, the word. So each one of these stocks worth $100. And let's say you really like this ice cream business, you think it's going to do well going forward, and you want to participate in its success. So you decide to invest your money into the ice cream business, and you receive one ownership share. So you're effectively becoming an owner of this ice cream business. And this is the exact same concept as buying a share in Apple or Google or Amazon, et cetera. Although at a much smaller scale, as those companies have millions and millions of shareholders. You might be thinking, what's the point? What's the benefit of owning part of a company? And the idea is relatively straightforward. At the end of the year, the money that the company makes actually belongs to the shareholders. It doesn't belong to management or to the employees, but to the owners of the company. So back to our ice cream example, let's say the company made $1,000 in sales, and at the end of the year, they had $900 of expenses. So at the end of this year, they have $100 of profit. The company may decide to give half of it, so $50, directly to the shareholders in the form of a dividend. And a dividend is essentially just a distribution of profit. So essentially the company pays $50 directly to you as a reward for being an owner. And it's easy to see how you earn a return this way, right? It's just a $50 payment directly to the shareholder. And the company might decide to take the other $50 and reinvest it back into the business to invest in growth or expand the business operations. In the example of an ice cream business, maybe they'll use that to develop a new flavor, which grows the business, makes the business more valuable, and therefore your share of the business more valuable over time. So it's really through dividends, which is just that payment to the shareholders, and capital appreciation, which is the value of the share increasing over time. There is a third benefit of owning a share, which is known as share buybacks. It's a little bit more complex, so I'm not going to get into it in today's discussion, but if you're interested, I encourage you to learn more about how those work. So you learned what a stock is, but what is the stock market? And the picture on the left, I'm sure many of you have seen, is a picture of the trading floor of the New York Stock Exchange. And the picture on the right, I think, is a good analogy for the stock market, and it's a picture of a very busy flea market. And I think it's a good analogy because when you think about what a flea market is, it's a place where buyers and sellers meet every day to exchange goods. Buyers try to negotiate with sellers to get the best possible price. But oftentimes buyers and sellers meet somewhere in the middle, they make a deal and they make a trade for goods. And it's the exact same concept in the stock market. However, instead of exchanging fruit and other physical goods, millions of people every day are exchanging ownership shares in companies. And this is happening all over the world. So if you wanted to buy ownership in a Canadian company, the biggest stock market in Canada is the Toronto Stock Exchange. If you wanted to buy ownership in an American company, there's a few different markets, but the New York Stock Exchange is the biggest. In the UK, you would buy it on the London Stock Exchange. In Japan, you'd buy it on the Tokyo Stock Exchange, et cetera, et cetera. I guess another main difference is at a flea market, when you're making an exchange or making a trade, you know exactly who you're making it with, and you know your counterparty. Whereas it's the stock market, it's all digital now. There isn't a place where you go and you actually exchange shares. It's all done digitally. So when you sell a share of a company, you don't know who you're selling it to. And when you buy a share of a company, you don't know who you're buying it from. But otherwise, I think it holds up as a good analogy and a good way to think about the stock market. So that's everything on stocks. Now let's get into bonds. And before we do, from a high level, when a company wants to raise money, they generally have two options, right? They can sell ownership, which means selling shares in the business, which we just went over, or they can take on debt through issuing bonds. So a bond is a loan an investor makes to a government or a corporation. The way it works is the company sells you a bond and agrees to pay you interest until the bond matures, at which point they pay you back your original investment. So think about going into a bank and getting a loan where you have to pay interest every year, and then you have to pay your loan back at the end of the term. It's a similar concept, but you're the lender in the situation, and the company or government is indebted to you, which is pretty awesome. So going back to our ice cream ice cream example, let's say instead of selling ownership in the company to raise money, they decide to issue a bond and issue a loan. So they issue a loan that's worth $1,000. Again, this is all hypothetical, but the issue of bond that's worth $1,000. The term, meaning the length of the loan or the length of the bond, is 10 years, and the interest that they'll pay you is 5%. So in this situation, you loan the company $1,000, and each year you receive $50 in interest until the bond matures in 10 years' time, and then you get your original investment back. Because of their guarantee, because you're getting these interest payments and your original investment back at the end of the term, bonds are considered lower risk than stocks. And this takes me to a very important concept when it comes to investing, which is the risk-return trade-off. And the idea is that in order to expect a higher return, you have to be willing to take on more risk. And I think a simple example will help illustrate this. So let's say you have all your money and you decide to give it to the government for 1 month. The government is stable and they own the printing press, so they can print money whenever they want. And therefore, the odds of them not paying you back in 1 month's time is pretty much nothing. So you're willing to give your money to the government for a low rate of return of, let's say, 0.5%. However, instead of giving your money to the government, you give your money to me. I'm a trustworthy person. I have a good job. I have a good credit score, but I don't own the printing press. I can't just produce money whenever I want. And therefore, you're taking on credit risk. And in order to lend your money to me, you're happy to. However, you require a higher rate of return to be compensated for taking on this additional risk. And we'll say 1%. Again, these numbers are hypothetical. And then I come to you and I say, instead of lending me the money for 1 month, I actually need this money for 5 years. And you say, Aiden, I don't know where you're going to be in 5 years. The world is constantly changing. And therefore, I'm taking on maturity risk. In order to give you the loan for 5 years, I need to be compensated for taking on this risk. and therefore I require a 1.5% rate of return. And then I come to you and I say, I'm actually moving to the UK and I need this money in pounds. And you spend Canadian dollars on a day-to-day basis, and therefore you're taking on currency risk. And you say, I'm happy to give you the money. However, I require a higher rate of return, and we'll say 2%. And then finally, I come to you and say, instead of lending me the money, I want you to invest in this new ice cream business. And you say, there's a chance that I never get my money back. There's a high chance that this business fails. There's no covenants on my money, so I can just lose it all. And therefore, I'm taking on business risk, or what we call equity risk. And therefore, I need to be compensated for taking this risk. So I require a higher rate of return. Right. So the idea is that there's no such thing as a free lunch in investing. In order to get something, you got to give something. And in this case, you need to take on risk in the short term in order to get a higher return in the long term. And if you look at the data, over time, risk has been rewarded in the long term. This chart shows the growth of $1 if you invested in each one of these asset classes. So $1 invested in US small companies, which is just an index of US small companies, and that's the top purple line. $1 invested in US large companies, which is the blue line, and think of the Fortune 500 companies in that bucket. $1 in long-term government bonds, which is the gray line, and those are 30-year government bonds. $1 in a high yield savings account, and then $1 just under the mattress. So as you can see, if you invested $1 in US small companies, that $1 would turn into almost $25,000 or over $25,000 almost 100 years later. So as you can see, you earned a huge return on your money. However, that didn't come without periods of risk, right? You can see in the 30s during the Great Depression, U.S. small companies and U.S. large companies, lost a lot of their value. In the 70s, you can see there's a big drop and a big downturn in value, and there's a lot of volatility. And the best way to think about volatility for me is to think about the jumpiness in price, and think about that the volatile price changes. So you can see in the 70s there was a lot of volatility. In 2008, 2009, up here was the great financial crisis, where stock market lost over 50% of its value over the course of a few months. And of course, during COVID, I don't have the data to show it, but the market went down significantly over the course of a few weeks. And even today, the market, if you've been following, the market's down over 15% year to date. So although you were rewarded, in the long run, there were periods of time where you had to experience risk and volatility. On the other hand, if you were to invest $1 in a high yield savings account, which is this dark purple line at the bottom here, that $1 would just be able to keep up with the pace of inflation. And inflation, I don't want to get too into it. I'm sure you've been seeing it on the news and reading about it. But from a high level, it's the increases in prices of goods and services over time. So that $1 invested in a high yield savings account, essentially you were able to maintain the value of that dollar. So you didn't really earn a return for putting your money in a savings account. However, that didn't come with any risk, right? There was never a time where this high yield savings account went down in value, and it was a smooth ride. There was no volatility. And then finally, $1, you just stuck that under your mattress in 1926 would be $1 almost 100 years later. However, it wouldn't be able to buy you much, as inflation has eroded away the value of that dollar, this green line here. All right, so as you can see, in the short term, it can be risky to invest because there are periods of downturns and volatility. But in the long term, it can be risky to not invest, as inflation can erode away the value of your dollar. Next, let's talk about investing versus saving. Saving means putting away money for short-term needs in a safe place, such as a bank account, and investing means taking some risk and buying assets that will ideally increase in value over time. And this triangle in the chart here is called a wealth pyramid, and this is something I do for my own financial planning. And the idea is to break out your goals based off time horizon. So you can see on the bottom, you have your short-term goals, in the middle, you have your medium-term goals, and your top, you have your long-term goals. And based off these goals, I allocate my cash towards the appropriate investment to achieve them. Because if you think about it, each time frame requires you to think differently about how you're investing and saving. So for example, short-term goals, these are things like your emergency fund, day-to-day expenses, vacation coming up in the next couple months. Because it's coming up in the near term, these goals, I can't afford to take on volatility or risk. And therefore, this bucket is invested in conservative and liquid assets like just cash in a savings account and a checking account. On the other end of the spectrum, the long-term goals, these are goals that are 20, 30 years out into the future, things like retirement or future children's education or philanthropy, et cetera. And because you have such a long time horizon to achieve these goals, you have the capacity to invest in riskier and growthier or growth-oriented assets to achieve these goals. However, I do want to mention that everyone's emotional risk tolerance is different, and you have to balance the emotional side with investing with your capacity to accept risk. So, for example, I might have the capacity to invest in risky investments for retirement that's in the long term. However, if I can't sleep at night knowing that the market crashed 30%, or if I can't stomach that, then I have to dial back the risks. So, I mean, this pyramid will look different for everyone in terms of what you're investing in, but I think it's a helpful framework, and it gives purpose and meaning to your investments, which will allow you to stay on track for your investment plan. The final investing principle I want to get to in today's presentation is the power of compounding. Compounding is known as interest on interest. It's when you don't only earn a return on your original investment, but you also earn a return on a return that you earned. So it sounds a bit confusing, but let's do a quick example. Let's say you have $100 and you invest it and you earn 10%. So at the end of the year, you have $110. Let's say you reinvest that back and you earn another 10%. So at the end of next year, you have $121 because you earned 10% on your original investment of $100, and you earned 10% on the $10 that you earned last year, which is that $1. And over time, this interest on interest effect can be very, very powerful. People refer to it as the snowball effect. So think of a snowball running down the hill, and as it gets bigger, it continuously picks up more and more snow. And at the bottom, it's this giant snow boulder. And compounding has a similar effect. I think an example is probably the easiest way to appreciate the power of compounding. So imagine we have two friends. One started saving and investing at 30 years old, and the other started 10 years later at 40 years old. They each started putting away $5,000 every year until they retire at age 65. So we have the one friend who started investing at age 30. We'll call him the smart friend because he started earlier. The total that he invested is $175,000, right? It's the $5,000 every year times 35 years. The friend that started investing at age 40, we'll call him the less smart friend. The total that he, because he waited the 10 years, the total that he invested is $125,000, which is 5,000 times the 25 years. This 10-year head start resulted in the smart friend investing $50,000 more than the other friend. So a little bit more, but nothing crazy. The question I want to ask all of you is assuming that they each earn an 8% rate of return every year, which is somewhat conservative, as the average annual return for the stock market is around 10%. But for the purpose of the example, assuming they each earn an 8% rate of return every year, how much more money does the smart friend have at age 65? Does he have A, $50,000 more, B, between $100,000 and $400,000 more, or C, $500,000 more? The answer is, let's see if this pops up, C. Just by starting 10 years earlier, the smart friend has $500,000 more than the less smart friend. And that is all thanks to the power of compounding. And when I look at this example, it reminds me that investing isn't about a once in a lifetime opportunity. It isn't about that, finding the next big thing. It's really a lifelong journey of prudent investments that grow with time. You just need to start small and let the magic of compounding really do its trick. And to make it more relatable to all of you, assuming that you're 20 years old in the audience and you started investing $5,000 per year starting today, and you earn an 8% rate of return, so the exact same assumptions that we used in the other example, you would have almost $2 million at age 65. So if you can, I encourage you to start as early as you possibly can. At this point of the presentation, I'm sure you're wondering or you're thinking, Aiden, this has been great. I've learned so much. This has been, I didn't know what a stock was before, but thank you for explaining that. But you must be thinking, how do I get started? Who can I speak to if I need help, and who can guide me through this journey of investing? And that's where myself and Seidel come in. So at a high level, Seidel is one of Canada's largest independent private banks. The firm was started in 1999, so we have about 20 plus years of experience. And since then, we've grown to over 20 billion of assets under administration, over 200 employees across our 4 global offices. So you can say that over the last 20 years, we've been doing something right. And in terms of what I do in our services, and what the rest of our team does is we take a holistic approach in managing our clients' entire wealth picture and not just one aspect of it. But first, think of investments. And at Seidel, we have a comprehensive range of proprietary investment strategies, everything from stocks and bonds, what we talked about today, to alternatives such as hedge fund strategies and private equity strategies as well. And although it's important to consider what you're investing in, how you're investing is equally as important, meaning should you be investing through your personal name? If you're a business owner, should you be investing through your corporation? Should you open up a trust and invest through your trust? And through our planning, structuring, and trust expertise, we have the solutions for our clients. And then lastly, on the banking side, we have a full suite of products that allow our clients to transact on a global stage. I think the best way to think about Seidel and what makes us unique, it's the fact that we have the scale and capability of a large bank. So think of the Scotias, the TDs, et cetera. We can do pretty much anything that they can do, but we have the look and the feel of a smaller, more boutique firm where we can create customized solutions that fit our clients' specific needs. And we don't take this cookie cutter and one size fit all approach that some of our larger peers take. And as you can see, we fit kind of perfectly in the middle here, and there's nothing in Canada that looks quite like us. And with that, that takes me to the end of the presentation. And to summarize, if you can take away a few things, I recommend it's mainly these four bullets. So first, why do people invest? It's to achieve our goals. Remember to start with your goals, and setting specific achievable goals can help you narrow your focus, create a plan, and stay motivated. What is a stock? A stock gives you ownership in a company. And what is a bond? A bond is a loan you make to a government or corporation. Remember that risk and return is related. Investing in stocks comes with more risk. However, it gives you the potential to produce higher returns in the long run. And remember to start earlier. The earlier you start saving investing, the greater chance it has to grow and benefit from compounding. So thank you all so much for tuning in tonight. And I'm going to pass it back to Candace for Q&A.
Thank you, Aiden. That was great. You got You got into some good topics there.
Yeah.
So in the interest of time, I'm going to hop straight into questions. And let me have a look. The first we have is, what resources would you recommend to people who are just starting with investing?
This is a good question, and something that I can definitely relate to. I remember, in school, you don't learn about investing. You don't learn what a stock is, what a bond is, et cetera. So I feel for the person who's asking this question. One thing I would say is that the internet is vast and has tons and tons of content. Some is really good, and then some I would kind of shy away from. Some of the TikTok investors or some of the YouTube videos are a bit sketchy, but there is some really good content. In the top of my head, I recently saw there's this fintech company in the US called SoFi, and they made an online course, like an investing kind of fundamentals 101 online course where there's like a full module. So I'd recommend checking that out. As well, there's many newsletters and articles. I've definitely tried to read Bloomberg and Wall Street Journal as much as you can. And there'll be some jargon, but you'll start to pick up on some of the language, which will be helpful. And then podcasts, I find, is an easy way to, or also an effective way to learn about investing. So Morningstar is a good podcast, a few of the banks as well. There's a Investing for Beginners podcast, which could be helpful. And lastly, I mean, if this person wants to reach out to myself or someone like me, I think, I'd be happy to also chat and help educate on that front.
Great, all good suggestions. The next question we have, should younger investors allocate all or most of their money to riskier investments?
It comes down to two factors. What are you investing for, and what is your emotional risk tolerance? So, for example, let's say you're investing all your money for retirement, which is 30, 40 years out. From a risk capacity perspective, you're able to withstand volatility in the market, and you're able to take on risk. However, if you don't have the emotional risk tolerance to invest in risky assets, meaning if the market was to crash by 30% and you wouldn't be able to fall asleep at night, you'd have to sort of dial back the risk. So it really depends on those two factors. And then on the other hand, like thinking about another goal that's in the short term, say you want to buy a car in a few years and you have a high emotional risk tolerance, because you only have a few years to buy this car, and you don't have the capacity to take on risk, and therefore, I wouldn't recommend putting everything in risky assets. So it's balancing those two things. And then I guess one point I want to make on risky investments, when I talk about them, I'm talking about stocks in companies that are profitable and that produce cash flow. Not all risk is not equal. So you can think of crypto and other non-profitable companies as risk investments, but we don't have the data to back up that in the long term, you'll be rewarded. Whereas with actual companies, you do. So I wouldn't recommend putting all your money into that. You can have fun with some of it, but definitely not all of that.
Good suggestion. Next question we have is, what if I have very little disposable income, but still want to do something with it?
It's another good question. And I figure there's some students on tonight, and there's people who aren't working, and this might be a struggle. What I would say is to focus on the expense side of things, and try to cut down any discretionary spending that you have. So, for example, let's say you buy coffee every day. If you try to limit that amount, and let's say you save $30 a month, you can send that to an investment account and start investing. And again, it doesn't matter how much you start with; it's just a matter of starting and letting that compounding effect happen. There is an app I saw recently called Milo, I think, and the idea is that on each one of your purchases, it rounds up the dollar amount, and then that difference they send it to an investment account. And I would definitely recommend checking that out. So there are ways to save, but I do appreciate that it's a bit challenging.
So it sounds a bit like a digital piggy bank.
Exactly.
Okay. The next one, why do stocks go up and down?
Another good question. There's a lot of good questions here tonight. And a
Yeah,
lot of
people are wanting to
challenging ones.
know.
Why do stocks go up and down? In the short term, it's sort of a mystery, and it's hard to answer that. I mean, everyone has their different theories, but it's difficult to answer. A lot of it is emotions, right? The fact that it's priced daily and people kind of act irrationally. Like I've always said, imagine if your house was, you saw the value of your house every day, and people would be acting differently and be acting irrationally. So in the short term, it's sort of a mystery, but in the long term, I have this great chart. I don't have it here tonight, but it essentially shows the relationship between stock prices and company earnings, and the relationship is almost, it's 90 something percent in the long term. So that it shows that there's a correlation with earnings, and at Seidel, that's why we focus on companies that produce cash flow, that have earnings, that are growing their earnings, as it's a tried and true approach to investing.
Okay. Let's see if we can squeeze in one last. We've got a couple of minutes left. Should I start now when everything is going down?
This is a question I think every investor has thought about at some point. And I want to share my screen and go back to one of the slides I presented, because I think it would be helpful to this slide. So, is now a good time? The question is, or the answer is that there's never really a right moment, and it never will feel like the right moment. Like going back to all of these different stock market crashes. So let's take, the 2008 financial crisis. In the moment, it seemed like a terrible time to invest, right? And if you had bought, somewhere on the way down and it kept going down, it would still feel terrible. However, it's really all about your time horizon that matters, because if you didn't invest and you just sat out, you would have missed out on tremendous returns over the next decade. So, the answer is to invest, as when you can, and not try to wait and not try to time it. Doesn't mean that you have to lump sum and put everything in on day one. You can sort of tranche in your investments over time, and that might help with some of the volatility and help with the possibility of you investing at the, a big market crash. But the answer is no, do not try to time the market. We don't know what's going to happen in the future.
And we need the crystal ball.
Yeah, and exactly. Nobody has a crystal ball, unfortunately.
Well, unfortunately, that's all the time that we have. We'll make sure to send an email with answers to the rest of the questions. We're sorry if we weren't able to get to your question. Just a quick reminder, as we end, you'll be redirected to a short quiz. If you'd like to take a shot at winning that $50 gift card, please fill it out. That's all from us this evening. Thank you.
Thank you.
Have a good evening.